Hello students, how are you all? I hope everyone is doing very well. So in the last class we have completed the chapter number 1. So today we are going to start our next chapter, that is the theory base of accounting. So what do you mean by theory base of accounting? Anything, any practical subject, that is let's say your maths, in your mathematics chapters, let's say any chapters, they have a theory base. Before you start the calculation process, you know the theory base of the chapter. So similarly for the accounting also, you know that accounting is related to something like it is based on some calculations and like preparation of statements and all. But for preparing such things or for such calculations, you have to know something related to the theory. You have to know the base idea, how to prepare those statements or how to calculate any profit or something that is related to the accounting. So this chapter, the theory base of accounting, will teach you the base. So what are the base that are required to calculate or to prepare some financial statements. So let's say so no discipline can be developed without a sound theoretical base. Yes, anything, any practical subjects you take, it will require a theoretical base. Without this, you can't start any calculation. Similarly, so the theory base of accounting, what does the theory base of accounting consist? It consists of the principles, concepts, rules and guidelines that has been developed over a period of time, that has not developed in a like in a year or in a month. It has been developed like in slowly and steadily. It has been developed over a period of time. So the principle, the concepts and how they have been developed, they have been developed by through the various observations and experiments. Those who have developed this, those accountants, so they have first of all observed the environment and then slowly and steadily they have developed these principles. So to bring, why this has been developed? To bring uniformity and consistency. Obviously, if you like in each and every company, they have to prepare some accounting statements. But for this, first of all, let's see, if the rules are not same in each and every organization, there will be a miscommunication, right? So for that, they have developed this accounting principle so that this can be followed by each and every organization and there is a uniformity, means there is a similarity in all the organization. So consistency to the process of accounting and enhances utility to different users of accounting information. So its uses that we are preparing financial statements for whom? For the management, for the for your employees and also for your your external users. So those external users, they can, so in order to be utilized by those external users, we have to prepare the financial statements according to the principles, because everyone who are using the accounting information, they must have they might have at least little bit knowledge of the accounting. So for this, because so in order to be utilized by them, the accounting information, this has been prepared according to your accounting principle. Now the Institute of Chartered Accountants of India, which is the regulatory body, this is the regulatory body or for standardization of accounting policies in the country, means in India, has issued accounting standards which are expected to be uniformly adhered to. So they have developed various accounting standards, which are the principles, you can say, according to which on the basis of which you are going to prepare the accounting statements, some rules or the principle. so that there is a consistency in the accounting practices, so that there is a similarity in the accounting practices. So there comes our generally accepted accounting principles, which is also called as the GAAP. So in order to maintain uniformity and consistency in accounting records, certain rules or principles have been developed which are generally accepted by the accounting profession. So these rules are called by different names. Sometimes it is called as concepts, sometimes as principles, conventions, postulates, assumptions and modifying principles. So these principles have been called by different names, but the meanings are same. So in order to maintain the uniformity, so that every organization who prepares a financial statement, they can follow those rules, so that everyone or who are using the accounting information has a perfect vision of it, like they can know it in a proper way. So this is our generally accepted accounting principles. This is the most important thing. So what do you mean by generally accepted accounting principle? So it refers to the rules or guidelines adopted for recording and reporting of business transactions. So these are the rules or the guidelines that has been adopted for recording and reporting of business transactions. Recording to, you know, what do you mean by recording? Means you are writing the day to day business activities, like there is a sale of rupees 5,000, so you are recording it, you are writing it. So these are the recording part. Now what do you mean by reporting? What do you mean by reporting? So reporting means communicating the financial informations to the management or to the authorized person who are eagerly waiting for the information. Now see, in the first chapter we have seen what do you mean by accounting. Accounting means it starts with recording of transactions, then it goes on with summarizing, interpreting, recording, then you have the classifying, then you summarize it, then you interpret it. So from recording to interpreting there is a step followed. So recording means recording the transactions, and reporting means the transactions that you have recorded, they are thoroughly studied, then you have to classify them on the basis of accounts, that which accounts they belongs to, then you are going to summarize it, like preparation of trial balance and all these things you are going to understand it better in the upcoming chapters. Just have a basic idea of it. Then you have to, like this day on date, like 1st of January you have purchased some items for 10,000. Now in the, like there are many transactions, so in 3rd January you have something, so similarly in the 2nd of Feb you have done something. So these all transactions are put together, and then there is a for each and every account, like there is a purchase, then there will be purchase account. In the purchase you are going to add all things that you have paid for, or you have in the purchase account you are going to add all those things that you have not paid for till now. Like you have purchased something, like you are in a you have a furniture shop. Now you have purchased some furnitures for resale. Obviously furniture shop, they are going to, sometimes they prepare by themselves, they prepare the furniture, but sometimes they also import some furniture, right? So they is let's say they have bought some furniture, now they are going to sell it, but when they have bought it, they have not paid the amount. Like they have like you have a furniture shop and you have bought some new design furniture from another furniture shop, so and you have not paid the amount, like you have to pay them 50,000. Now that 50,000 you have not paid, so the amount that you have not paid will be included in the purchase account. Means this only includes the credit purchase, so that you have a record to whom you have to pay by the end of the year. So similarly, so such all things are to be recorded and these are to be reported to the financial information. Like you have to prepare the financial statements in the end of the year. So after that you are going to know what assets you have in your hand, what are the liabilities that you need to pay back. So these are the things that these are the information that are that must be shared to the management and also to the external users of information. So this is the reporting part. So in order to bring uniformity in the preparation and presentation of the financial statement, so that in order to prepare the financial statements in a uniform manner, so that in every organization, in each and every organization, they follow some rules or principles, say, so for preparation of financial statements, in order to be visualized by each and every accounting information users, so that the users of accounting information can understand it in a better way. That's why this generally accepted accounting principles has been prepared. So, but these principles of accounting are not static in nature. Static means that does not change. Static means that does not change, but these accounting principles are not static in nature, means they are bound to change according to the situation arises. These accounting principles are bound to change in the upcoming years also. These accounting principles that we have now today, these are prepared, these have been modified this has been modified by the accountants in the on the basis of our needs. So these accounting principles are not static in nature. These are constantly influenced by the changes in the legal, social, economic environment. So in each and every environment, if there is a change, then accounting principles are bound to change. As well as per the needs of the users also, these accounting principles may change. So these principles are also called your concepts and conventions. So what do you mean by concept? Concept refers to the necessary assumptions and ideas. So these are the necessary assumptions and ideas which are fundamental to accounting practices, which are important to the accounting practices. And the term convention means customs or tradition as a guide to the preparation of accounting statements. It does not mean that all the customs and tradition that you follow, but the relating to the accounting statements. So the custom and tradition, that the traditional way that we are using, these things forms the background of the accounting principles. So they form a guide to the preparation of accounting statements, and your concept refers to the assumptions and ideas which are fundamental to accounting practice. Means this has to be done so that the accounting statements look much better. Now from the practicability viewpoint, it is observed that various terms such as principle, postulates, conventions, modifying principles, assumptions have been used interchangeably. Means in place of principle you can use postulates, in place of postulates you can use convention. So similarly, so all these terms has been referred to as the basic accounting concepts. They referred to as the basic accounting concepts. So we are now going to study the basic accounting concepts, on the basis of which you are going to prepare your financial statements, or you are going to solve each and every accounting problems. So the basic accounting concepts are referred to as the fundamental ideas, the most important ideas, or the basic assumptions. Every accounting in each and every accounting part there is an assumptions. Because of these assumptions they have prepared some or the other principles. So these assumptions are very important. So these are underlying the theory and practice of financial accounting and are the broad working rules for the accounting activities and developed by the accounting profession. So these are developed by the accounting profession. So what are the most important concepts? These are your, first is business entity, then money measurement, going concern, then accounting, then cost, dual aspect, revenue recognition, matching, full disclosure, consistency, conservatism, materiality, objectivity. So these are the various concepts. Don't worry, you are going to be confused, but we will discuss in this class only what are the different accounting concepts and what does each and every accounting concept means. Business entity is nothing, just it means that business is different from the owner. That if owner have a bank account, then the business entity also should have a bank account. You may have seen that in each and every organization there is a different account named by the organization. In each and every banking institute there is a account open for each and every organization rather than the owner, right? The owner's account may be there in the bank, but apart from this there is another account related to the organization, like SBI in the for example, let's say ITC Limited. So they have one account there. So they are the most established business enterprise right now. So they might have a multiple accounts in each and every bank. So but this means business entity means the business is totally different from the owner. Next is money measurement. This one we have discussed in the characteristics of accounting, that in accounts all the things that are related to finance that are of financial nature, these are only recorded. Money measurement concept means you have to record all those transactions which are related to money or which can be recorded in terms of money. Those can only be recorded. Like there are like somebody has said, today we have sold 500 chairs. Okay, 500 chairs we have sold, but there is 500 chairs, but they don't they have not said what amount you are going to get back from this. So that means there is no amount related to this. So this thing cannot be recorded in the accounting information. But if he would have said that 500 chairs of rupees 100 has been sold, if they have said that 500 chairs of rupees 100 has been sold, then you could have said then we could have recorded it, because you know the amount. They have said of rupees 100 each, right? So if per chair the amount is 100, so for 500 chairs you know the amount, 500 into 100, so the amount is 50,000. So this can be recorded. So only the items that are of financial natures or only the items that can be recorded in terms of money can only be recorded in the financial statements. Next, you have going concern concept, means the business should go on. The business should not stop. If it has started, it should go on for a prolonged period. That means yes, some business like in a year it may due to ongoing losses they might shut down, but according to this concept it says the business must go on. Next, the accounting period means there must be an accounting period under which the financial statements needs to be prepared. So in today's time the accounting period is from 1st April to 31st March. Next we have dual aspect concept. Next we have cost. So that all the items are to be recorded according to their cost. So this thing you have to record. Next we have dual concept or the duality concept. That means that for each and every transaction that affects two accounts. For example, someone has someone has brought in some capital. You know what is capital? Capital means the assets, the cash, in form of assets. If the owner has bring in and they have started the business, then those things are your capital. The amount that has been invested in the business in the starting point, that is your capital. But someone might have said that now I want also to be part of your business enterprise. Now what will he do? Means, like if you have a shop, if you will allow someone to be the owner of your shop? No, right? Because they have not invested anything in them, so they might just take the profit away. No, you can't do this. Because so what will we do? So like I have a shop and I have a stationery shop. Okay, I have a stationery shop. So I have started my shop by investing like 2 lakh amount and for 50,000 rupees of items worth 50,000. So I have invested 2,50,000. Now one of my friends says that I also want to be a part of your stationery shop. But how can I allow without any assurance, without anything? So he might say that I am going to bring in 20,000 items worth 20,000. He is bringing items of 20,000 and also bringing out 80,000 cash. So total he is bringing 1 lakh rupees. So 20 in the form of assets and 80 in the form of cash. 20 in the form of goods and 80 in the form of cash. So when he says this, so I might be in a need of this money. So I will say yes, you can be a part of my shop. You can also be the owner of this shop. So let's invest this amount in our shop. So that time that time we have the, so he has bring in capital. Okay, so let's say his name is Mr. A. So he has bring in capital. So he has brought in capital. So this amount that he has brought is to be added to our capital account. So he has brought cash, right? So cash would be debited and to capital account. This is the journal entry. We are going to study it in later on. So cash has been debited means he has brought in cash and we are getting in the form of capital. So there two accounts has been used, cash account and also the capital account. So dual aspect is nothing, it just affect in each and every transaction, it just affect your cash, your two accounts. Let's say another example, purchase of goods. You have purchased goods of 10,000 on cash. Now purchase of goods on cash. Now purchase means you are getting something and you are paying out something, right? You are getting some items. So in your stocks, in your goods, that the things that you have in your shop, the stock that you have in your shop will be added, 10,000 will be added to them. Like you have imported something, you have bring in something to the shop for 10,000 rupees. So you are getting some things, but in place of this you are going to pay back some amount. You are going to pay 10,000 to the person from whom you have bought these things, right? So at that time you are getting something and you are giving out something. So there is two things, right? Cash you are giving and purchases you are getting. Purchases means the goods you are getting and the cash you are giving out. So there are also two accounts has been affected. So dual aspect just means that in each and every transaction two accounts will be affected. Next is revenue recognition. Revenue recognition means the revenue should be recorded when it is realized, not when it is received. Means you have realized that you are going to gain profit. You have calculated that this amount of profit you are going to get in this year, but maybe there are some persons that have not paid the amount to you. So maybe there are some debtors. You know who is debtors? Debtors mean those persons who have bought something from us and who are from whom we are going to get the amount, but they have said they are going to pay it back in the later of the month, in the end of 3 months, let's say. So from him we are going to get 10,000, let's say. So this 10,000 we have not yet received, but still this would be included in our profit. So we are going to say that we have realized it. So revenue should be recorded revenue should be recorded when it is realized, not when you have received it. Before receiving also you can record. Matching concept means the revenue should be matched with the expenses of that period. Full disclosure means every information should be disclosed. Consistency means there should be a consistency. The accounting concept that you are using should be consistently used. So these things we have. Now we are going to study this in the objectivity, materiality. Materiality means all the things of material nature should be recorded. They should not be ignored. Material nature means like there is a change in your depreciation type. Like there is two types of depreciation in you will study, like straight line method and written down value method. Let me say. So in the straight line method, what are you going to say? Like you have furniture. You have your furniture for 50,000. For first year, let's say you are going to deduct it by 10%. This is your depreciation amount that you have. You are just assuming that you have used this much of the furniture. So for the 50,000, 10% is your 5,000. So after deducting, what is the value of furniture now? You have 45,000. Right. This is for the first year. Then again in the second year also, you are going to deduct 10%. So you are just decreasing the value of the asset that you are using, because you have bought one furniture, that value is not going to be same in the end of the 5 years, right? When you are going to resale it, there won't be the same value. You are not going to get the same value because you have used it. So for that you are just deducting the decreasing amount. So similarly for this 10% is your 4,500. So the remaining value is 40,500. Again your 10% is 4050. So this way you have calculated. So this thing that you are going to deduct, this is your written down value method. It means in each and every year the depreciation value is decreasing with the value of the decreased value of the asset. So here we have calculated 5% on the 10% on this amount, then 10% on this amount, then 10% on this amount. So this is your written down value method. Written down value method. Now in the straight line method, what are you going to do? Like 50,000 furniture you have. So for this 10% is 5,000 you will deduct for first year. Then again in the second year also you are going to deduct 5,000. Then again in the third year also you are going to deduct 5,000. So the depreciation value is same in each year. So this is the method called straight line method. So there are two types. So in every organization they have their like way of solving the depreciation. Someone may use the written down value method or some may use the straight line method. So by chance if you have changed that you are going to now from today on I am not going to use the straight line method, I am going to use the written down value method, then that should be like informed to the accounting users. So let's start. So first is the business entity concept. Now what do you mean by business entity concept? Business entity concept assumes that business has a distinct and separate entity from its owners. Means the business and owners are different. Those two things, those business and owners, these two are two different items or two different accounts. It means for the purpose of accounting, the business and its owners are to be treated as two separate entities. So for any accounting purpose you are going to treat them as two separate entities. Now the accounting records are made in the book of accounts from the point of view of the business unit and not of the owner. So the accounting records that you are going to record, these are only in the point of view of the business, not on the point of view of the owner. Like let's say the owner has used 2,000 amount from the business, like from the profit that he has received in the business, from that he has used like 50,000 amount he has taken for his personal expenses. So that 50,000 is from the business he has taken out, right? That is not his own money, we can say. Yes, it is his own money, he has invested in the business and he is only getting the return, but he has taken this from the business. So that 50,000 would be recorded in the accounting record as drawings. So the personal assets and the liabilities of the owners are therefore not considered while recording and reporting the assets and liabilities of the business. So the personal things, this should be kept in aside from the business. So personal transactions are not recorded in the books of business unless it involves inflow or outflow of business funds. So if there is no flow in the business funds, then this should not be recorded in the business transactions. So with this we shall end our class today, and in the next class we are going to discuss the other concepts. Till then, take care.